Welcome to the Goose Hollow Capital Weekly Market Update. In this edition, we recap recent events, preview what's on the horizon, and share some interesting charts that caught our attention.
Welcome back for the deep dive this week. You guys have sent over a ton of really fascinating stuff again. We've got market updates, we've got, the usual economic analysis, but then you threw in some political forecasts this time, which is always a little spicy.
Yeah, always adds a little bit of intrigue when you start factoring in the political landscape.
Did this deep dive. Hopefully, you will know if you should be excited about China or terrified about your savings account, or maybe a little of both.
Possibly both.
Yeah.
Yeah, there's a lot to unpack there for sure.
There is. So let's maybe start with China, because they just went and did something kind of big, right? I mean, this is the biggest stimulus package they've done since COVID. We're talking interest rate cuts. We're talking help with mortgages, even a little boost to their stock market. What is going on, and should we be paying attention?
It is definitely something to pay attention to. China's economy hasn't been really firing on all cylinders. They've had some troubles in their property market. Growth has been slowing, so they needed to do something to kind of jumpstart things. And this package seems to be their attempt to inject some life into the economy, boost confidence, and hopefully, get things moving in the right direction again.
Okay, so makes sense. They want to juice the economy a little bit, but will it work? Like, is this the right move? And what does it mean for us? What does a more stimulated Chinese economy actually mean for everyone else?
That's the big. But obviously, Goose Hollow sees some potential with this new stimulus package. So definitely something to watch.
Okay, so China. We're watching. But speaking of things we should be watching, this chart you sent over about AI pricing kind of blew my mind. Like, it is literally plummeting the cost of these models.
Yeah.
It feels like something big is about to happen.
It does, and I think what's really fascinating here is that it's not just the technology is getting cheaper, which it is, but it's what that means for accessibility. As these AI models become more affordable, they're suddenly available to way more businesses and even individuals.
Which means we could be seeing like a rapid acceleration of AI adoption across industries. And that just makes me think, like, massive changes, disruptions even, to how we work, how businesses operate.
Absolutely. And this is where it goes from exciting to, we need to start asking some serious questions. What happens to jobs that can be automated by AI? How do we make sure that as it becomes more powerful and more accessible, that it's being used ethically? I mean, these aren't hypothetical questions anymore, right? These are things we need to solve, like, now.
Yeah, it's a lot. And it's funny because on the one hand, the potential is incredible, but then there's this other part of me that's like, whoa, this feels like it's happening so fast.
It's a powerful technology. And like any powerful technology, we just need to be prepared on all fronts.
Okay, so from AI, maybe let's shift gears for a second and talk about the U.S. economy, because full disclosure, this is where I always get a little confused, because we're seeing these mixed signals. So on the one hand, unemployment is low, which on the face of it sounds like a good thing, right? But then there's this other thing, this labor differential thing that's actually dipping. And then you've got the stock market, which seems to be doing okay, but then consumer confidence is kind of shaky. Like, what's the real story here?
Yeah, it is a mixed bag. That's a good way to put it. Let me try to unpack the labor differential piece a little bit. So essentially, it measures how easy it is for companies to find workers versus how easy it is for people to find jobs. And when it dips, even with low unemployment, it can actually be an early warning sign. It might mean that employers are starting to get a little hesitant about hiring, which could then lead to an economic slowdown.
So it's like the canary in the coal mine, this labor differential.
Yeah. A very subtle shift in sentiment that can sometimes be a leading indicator of some broader trends. And so when you combine that with these other things, the fact that, the market's kind of optimistic, but consumers are a little shaky, it just creates a very, very interesting but uncertain picture.
Interesting and uncertain. Okay, well, adding to this whole economic puzzle that we're trying to solve, you flag something else that I've got to admit has me a little worried, and that is the U.S. personal savings rate. You said it's below 3%. That can't be good, right?
It's not great. Essentially what it means is that people are spending pretty much all of their income, which, on the surface can be good for businesses in the short term, but it's not really sustainable.
No, it feels like we're all living on the edge a little bit.
In a way, yeah. And to be fair, Household balance sheets, so like how much debt people have versus their assets, are in much better shape than they were back in, say, 2007 before the financial crisis. But this heavy reliance on low savings to kind of fuel spending, it makes the economy vulnerable. Because if something happens that disrupts people's ability to spend, like a recession hits or even just like a loss of confidence, it can have this ripple effect.
So, okay, so help me understand this. What happens if the savings rate goes up? Because that would mean people are spending less. Right. So is that a good thing or bad thing?
Well, it's kind of a double-edged sword. A rising savings rate can sometimes be a sign that people are nervous about the economy,
Right.
which ironically can actually contribute to a slowdown. But it also means that consumers are in a stronger position long term. They've got a little bit more of a cushion to weather any storms.
So it's about finding that balance.
Yeah.
Spend enough to keep things moving, but save enough so that, if something happens, you're prepared.
Exactly, exactly. And this is where it gets really interesting because this is something that the Federal Reserve, the folks who control interest rates, are watching very, very closely. And in particular, they're looking at this thing called the PCE deflator.
What is that? The PC?
The PCE deflator, yeah.
Okay.
So,
The election. Because let's be honest, what happens in Washington has a way of impacting everybody's wallets. And the predictions you sent over, pretty interesting. Looks like the Republicans are favored to take Congress, Democrats maybe hold on to the Senate, and the presidential race, well, that's anyone's game at this point.
yeah, it's definitely shaping up to be a close one. And if those predictions do hold true, it looks like we're heading for, well, more of the same, right? Divided government, Republicans controlling Congress, Democrats, the Senate.
Which means more gridlock, right?
Yeah.
I mean, haven't we seen this movie before? So for someone like me, just trying to figure out what to do with my money, what does that actually mean?
Yeah, it's a good question. And you're right, divided government does often lead to legislative gridlock, makes it harder to pass those big sweeping pieces of legislation. And historically, the markets have kind of interpreted that as a sign of stability on the one hand, but also less potential for those big policy changes that can really move the needle, for better or for worse.
So less risk, but also potentially less reward.
Yeah.
Kind of a bummer.
Well, it's not necessarily a bad thing. It just means we need to be a little more strategic, right? Understand which sectors, which asset classes tend to perform well or maybe not so well in a divided government scenario. For example, industries that rely on government contracts, they might see less growth if spending is constrained.
Okay, so it's not just about who's in power. It's about understanding, the policies and how they might play out.
Got it. Okay, can we please talk about these charts now? This is my favorite part.
Of course. Yeah, visualizing data, it's always illuminating.
Okay, so our first contender. This chart comparing Greek and French government bond yields. Okay, so rewind a few years and Greece was like the poster child for financial instability, right? And now their bond yields are lower than France's. What is happening? Did Greece just become like a safe haven all of a sudden?
Probably not a safe haven just yet. But this chart is really interesting because it speaks to the long game, the long-term impacts of fiscal policy. Remember the whole Greek debt crisis. Years of really, really tough austerity measures followed. Painful in the short term, but they have helped stabilize the economy. France, on the other hand, has seen, increased government spending, which can put upward pressure on bond yields.
So it's all relative, doing better compared to where they were and also in comparison to what France is doing right now. It's not necessarily about one country being good or bad, but understanding the context, the bigger picture.
Absolutely. It's all about those relative dynamics. Okay, moving from bonds to something a little more, shall we say, glamorous.
Gold.
It's had a pretty good year, and this next chart you sent, comparing its performance under different presidencies, this one's interesting.
Interesting is an understatement, because if we're reading this right, gold seems to do a lot better when a Democrat wins the White House. Is that real? Is that just a coincidence, or is there something more to it?
It is pretty fascinating, isn't it? But this is where we have to be careful about not jumping to conclusions. Just because two things happen at the same time doesn't mean one causes the other. Correlation doesn't equal causation, as they say. We'd really need to dig into the weeds, look at the historical data, the economic conditions during those periods to say for sure if there's a causal link.
So maybe don't go betting the farm on this one chart just yet. Noted. Okay, the last one. This one's from OPEC, the oil cartel, and they just came out with their latest oil demand forecast. And spoiler alert, they are feeling good, really good, projecting strong demand all the way to 2050. Do they know something we don't?
Well, they definitely have a vested interest in seeing continued demand for oil, that's for sure. But realistically, it's kind of hard to square their optimistic outlook with, well, with everything else that's going on, right? I mean, the
Yeah.
push for renewable energy, electric vehicles, that's not slowing down.
It's like they're saying, yeah, sure, everyone's going electric, but they're still going to need a ton of oil. Seems a little, I don't know, out of touch maybe.
It really highlights the tension that exists right now between the existing energy infrastructure and this global push for cleaner alternatives. The transition is happening, it's definitely accelerating, but it's not going to happen overnight. And so OPEC's forecast, well, maybe a little too optimistic, it does serve as a reminder that the shift to a truly sustainable energy future, it's going to be a process.
It's wild, right? It's like this weird push and pull between what we know and what's coming. You know what I mean?
Totally. Like this tug of war playing out across the board, right?
Right.
Every sector, every economy.
Yeah. And honestly, there's a lot to unpack here, even just on what we've talked about today. So if you had to boil it all down, just give me like one piece of advice, for someone who's listening, who's trying to make sense of it all, what would it be?
Don't get complacent. I mean, the
Yeah.
future's not set in stone, right? Things change, sometimes quickly. So stay informed, pay attention to what's happening, and be ready to adapt. That's the key.
So no crystal ball then.
Nope. Afraid those are in short supply these days.
Yeah.
But hey, good information, a little bit of healthy skepticism, and the willingness to, adjust your course if you need to. That's a pretty good substitute, I'd say.
Solid advice.
Yeah.
And you've definitely given me a lot to think about today. I mean, China throwing a Hail Mary, AI going from like 0 to 60 in a heartbeat, the U.S. economy, I don't know what it's doing, honestly.
Sending some mixed signals, for sure.
Major mixed signals. Oh, and my personal favorite.
Yeah.
The savings rate. It's basically non-existent.
Yeah.
I'm stressed.
Yeah, that one's definitely worth keeping an eye on.
No kidding. It's easy to get caught up in the day-to-day headlines, but you really help me zoom out a little bit, see the bigger picture, and that is, it's a little intimidating, I'm not going to lie.
Knowing is half the battle, right? Even when it's a little unsettling.
That is a very good point. And speaking of unsettling, this whole AI thing, we were talking about the possibility.
This material is intended for information purposes only and does not constitute investment advice, a recommendation, or an offer or solicitation to purchase or sell any securities to any person in any jurisdiction. The opinions expressed are subject to change without notice. This information is not intended to be complete or exhaustive, and no representations or warranties, either express or implied, are made regarding the accuracy or completeness of the information contained herein. This material may contain estimates and forward-looking statements, which may include forecasts and do not represent a guarantee of future performance.